Most traders are opening their charts this Monday seeing US dollar to Japanese yen at 161.38, a strong buy on the monthly, the weekly, the daily, every moving average sloping up like a launchpad. They're reading the Goldman note that just dropped, revising the 3-month target to 162 and the 12-month target to 165. And they're thinking, this is easy, just buy it. That collective certainty is the most dangerous thing in the market this week, because price is already kissing the zone where the BOJ intervention ghost lives, where last time we saw a 400 pip wrecking ball. This week has one danger zone and one 3-5-day opportunity. I'll show you both right now. Stay to the end. I'm giving you 2 Monday scalps and 1 swing trade that can run the next 3 to 5 days. Write this down. The line that defines your entire week is 162.00. If we close above it, the monthly structure resets. If we reject it, the trapdoor opens. The 3-5-day structural bias is a trending breakout attempt with a high-risk reversal tail. We are bullish while above the weekly pivot at 161.59, targeting the 162.11 to 162.47 resistance cluster. But the moment we get a daily close back below 160.71, that's S2, the whole weekly bias flips to a fast fade towards 159.00, right into the 20-day moving average that's been the trend floor for 3 months. Write this number down. 160.71. If that level breaks this week, the entire monthly trend of higher lows is violated, and you can kiss the 162 breakout goodbye. That's your invalidation. Now, here's the micro insight about where the herd is positioned. The retail crowd is already heavily long, and institutional desks are net long but trimming into strength, according to the latest COT and prime brokerage flows. That means buy stops are piled just above 162.00, and sell stops are accumulating below 161.23, Friday's low. The week is set up for a liquidity run in both directions, a stop hunt above 162 that sucks in breakout chases, then a potential aggressive reversal if the BOJ even tweets. The dollar yen trades on the yield differential between the US 10-year and the JGB 10-year. That spread widened again late last week, which is what's propping up the pair. But if Wednesday's FONC minutes even hinted a pause in the tightening cycle, that spread compresses, and US dollar to Japanese yen will drop like a stone. That's the macrofuse.technical deep dive, 110 to 430. Let's walk the timeframe alignment because this week it's both clean and treacherous. On the weekly chart, price is hugging the upper Bollinger Band, and the 5-week moving average at 160.84 is acting as the dynamic support. The 20-week MA down at 159.09 is irrelevant this week. That's a longer-term swing invalidation. The weekly MACD is still printing higher histogram bars, no bearish divergence yet. The macro pulse is accelerating. But the RSI at 62.5 on the daily is not overbought, so there's room. On the weekly, we have a clear resistance level at 162.11, the previous swing high, and then the psychological 162.47 to 163.00 zone that was last seen in 1986. That's a generationally significant level, and it will not be broken cleanly without a fight. Drop to the daily chart. The daily trend is strong buy, and price sits comfortably above the 20-day MA at 159.09, the 50-day at 156.09, and the 200-day WARE down at 145.86. That's a 15-figure gap. The daily MACD is positive, but the histogram bars are flattening just a touch, which often precedes a 2-3-day consolidation. That's exactly the kind of pause that creates the Monday scalping windows. The daily support stack starts at 161.23, Friday's low, then 160.71, which is the confluence of S2 and the prior breakout point from 2 weeks ago. A daily close below 160.71 would bring the 20-day MA into play and probably trigger a broader stop run. On the resistance side, 162.11 is the immediate barrier. A daily close above that opens 162.47, then the big figure 163.00. Now, here's the timeframe fracture that most traders will miss until Wednesday. The 4-hour trend is a sell. That's right, on the 4-hour chart, we have lower highs and the MACD is already crossing bearish below the signal line. The 4-hour 20 MA at 161.52 is bending flat, and the 60 MA at 161.20 is providing tentative support. This tells me that the short-term momentum has stalled. The 1-hour chart, however, is a buy. It bounced off the 161.23 support and is trying to reclaim the 1-hour 60 MA at 161.40. So we have a tug of war. The 4-hour is trying to correct while the 1-hour is trying to resume the daily uptrend. This compression will resolve in the next 24 to 48 hours, and it will produce the week's first explosive move. The daily ATR is 1.97 yen, meaning a normal range is about 197 pips. If we compress early in the week, the expansion later will be violent. That's where the swing trade lives. Cross-asset linkage is critical this week. US dollar to Japanese yen is the risk asset shadow. If S&P 500 futures hold their weekly gamma levels and push higher, the carry trade loves dollar-yen long positions. But if equities falter, the yen strengthens as a safe haven. Keep one eye on the E-mini and the VIX. If VIX spikes above 18, the 162 breakout dies quickly. Here's what most traders will miss until Wednesday. The weekly pivot at 161.59 is the magnet for the first half of the week. Whichever side of that pivot we accept on a 4-hour closing basis dictates the direction into the FONC minutes. Monday's entire session will be a battle for that pivot. The weekend news was dominated by Goldman Sachs revising their US dollar to Japanese yen forecasts to 162 in 3 months and 165 in 12 months. That's the narrative the market is waking up to. But let's connect the institutional flows. Large macro funds have been adding to long dollar positions ahead of the July 4th liquidity thinness, expecting a low-volume grind higher. That's the melt-up scenario. However, the Ministry of Finance and the BOJ have historically used thin liquidity windows to jawbone or even conduct stealth intervention. The last time we were above 160, the BOJ's verbal warnings ramped up, and we saw a 200 pip air pocket. This week, the intervention ghost is real because we're exactly at the level where they've drawn the line in the sand before. No one knows the exact trigger, but the market prices it as a binary event. The upcoming week's event calendar has one high-impact day, Wednesday. That's when we get the FONC minutes from the June meeting. The minutes will reveal just how divided the committee is on the path of rates. If the language reveals a growing camp favoring a pause, the dollar yield advantage narrows, and US dollar to Japanese yen could shed a full big figure in a single session. Thursday brings ISM Services PMI, which is a direct read on the US economy. A print below 50 would be a risk-off shock and would likely spike the yen. Friday is relatively quiet, which sets up a positioning battle into the weekend. So the narrative web for the next 3-5 days is this. Monday and Tuesday are technical liquidity-driven sessions around the pivot. Wednesday is the event fuse that either validates the breakout or sparks the reversal. Thursday confirms. Friday is the resolution. My 1-2 week directional lean is cautiously bullish as long as we hold above 160.71. But the exact event that would invalidate that and flip me outright bearish is a FONC minutes-driven break below 160.35 with a daily close. That would signal the trend exhaustion and a fast trip to 159. Do you think the dollar closes above 162.50 this Friday? Comment yes or no. I'm tracking consensus for the week. Drop it now. I'll read everyone. Most people skip the planning phase. That's exactly where this week's money is made. Keep watching, because the difference between a winning week and a blown account is executing these setups exactly. I'm giving you 2 Monday scalps and 1 3-5-day swing. Strategy 1, the Monday opening scalp. This is a high probability snipe designed for the first 1 to 3 hours of Monday's London-Asia overlap. The trigger. Price retests the 1-hour 20 MA and the weekly pivot, right at 161.60 to 161.59, and holds a 5-minute bullish bid. Wait for a 5-minute candle to close above 161.65 with a higher low in the RSI on that time frame. Entry is then a market long at 161.65. Stop loss at 161.45, just below the Asian session low and the 1-hour 60 MA. That's a 20 pip stop. Take profit 1 is 162.10, just under the daily A1 and the psychological resistance. That gives you a 45 pip profit target, a risk reward of 1 minute and 2.25 seconds. If the 5-minute candle closes back below 161.50 before you're filled, the scalp is void. This trade exploits the Monday morning liquidity injection as the market reprices after the weekend. The Monday opening SCALP entry, 161.65, 5M bullish reclaim of 1H20 MA and weekly pivot, stop loss, 161.45 take profit 1, 162.10 risk, reward, 1:2.25 invalidation, void if 5M candle closes below 161.50 strategy 2, the Monday liquidity grab. This one is counternoise, aggressive, and designed to exploit the stop hunt that the 4-hour sell trend will try to engineer. Friday's low was 161.23. The Asian session range likely hugs that level. What we are looking for is a fake breakout, a quick spike below 161.20 that grabs sell stops, then snaps back above 161.40 within 15 minutes. That wick is your signal. Entry is long on the snapback, once we get a 15-minute close back above 161.40, with entry at 161.45. Stop loss is placed at 161.15, 5 pips below the wicks extreme, which should be around 161.20. So a 30 pip stop. Take profit is the nearest liquidity pool, which is the 161.90 to 162.00 area, the pre-weekend consolidation high. That's a 45 pip target from 161.45, risk reward 1 minute and 1.5 seconds. This requires aggressive execution and a calm head. If the fake breakout doesn't happen within the first 2 hours of London, the pattern expires and you stand aside. Warning: if the spike goes below 161.00 and doesn't recover, it's not a grab, it's a genuine breakdown, and the swing trade invalidates. Monday liquidity GRAB entry, 161.45, 15M close above 161.40 after stop hunt below 161.20, stop loss, 161.15 take profit 1, 161.90 risk, reward, 1:1.5 invalidation. Pattern expires if no fake breakout by 11 a.m. London time. You scalping Monday or swinging the week? Comment scalp or swing. Let's see who's built for this market. I want to know the split before we get to the swing. Strategy 3, the 3-5-day swing. This is the core trade aligned with the weekly and daily strong buy trend, designed to capture the move from the liquidity consolidation into the breakout beyond 162. The entry trigger is a daily close above the weekly A1 at 162.11. Not an intraday poke, a confirmed close on the daily chart. Entry would then be at the opening of the next session, roughly 162.15, on any small pullback. Stop loss is placed outside the weekly structural level, below the 160.71 S2 and the prior week's breakout point. I'm setting the stop at 160.60, which gives a 155 pip buffer. That's wide, but it needs to be to survive the intra-week noise. Conservative target 1 is 162.90, just under a 3, for a 75 pip gain. That's roughly a 1 minute and 0.5 seconds of first target, but we are aiming for more. Stretch target 2 is 163.80, an extension measured from the daily ATR projection and the next big psychological figure, for a total gain of 165 pips. The risk-reward to target 2 is roughly 1 minute and 1.06 seconds, so to improve the ratio, we use a trailing stop. Once price reaches 162.50, we lift the stop to break-even at 162.15. At 163.00, we trail to 162.50. At 163.50, trail to 163.00. The explicit invalidation that would negate the entire weekly outlook is a daily close below 160.35. S3 and the last line of support before the 20-day MA breaks. If that happens, the swing is dead, and you exit immediately to 3-5 days NG entry, 162.15, on daily close above 162.11, next session open, stop loss, 160.60 take profit 1, 162.90 take profit 2, 163.80 risk, reward, ~1:1.06, R improves with trailing stop, invalidation, void if daily close below 160.35 never risk more than 1 to 2% per trade. Holding through Wednesday's FONC minutes requires tighter sizing. The swing stop is 155 pips wide. Calculate your position size so that a full stop out is 2% of your account. Stops are non-negotiable, especially on the swing. This is how you survive to trade the next big weekly move, because dollar-yen doesn't care about your opinion. The single most critical level to watch for the entire week is 162.00. A daily close above it opens the melt-up towards 163. A rejection with a long upper wick on the daily and a drop back below 161.59 revives the intervention collapse narrative. That one level defines your whole week. If this level breaks decisively on Friday, the monthly trend flips into acceleration mode, and the targets get exponentially larger. If it fails, we are looking at a 200 pip mean reversion. I'll have the updated blueprint for you this Sunday, with the fresh weekly pivot and the new trade structures. Until then, I want you to go back and watch last week's US dollar to Japanese yen recap. It's live now, showing exactly how we caught the 160.50 reclaim and rode it to 161.80. Tap the end screen, then hit the bell so Sunday's next week ahead alert lands before the open. Hold the like button and subscribe. Every signal helps the algorithm bring you the levels that define your week. This week is ruled by 162.00. I'll see you on the other side of it.